Divergences. This is a very interesting phenomena, and I've been thinking all over about this since the beginning of my financial market career. Divergences are really very interesting because they tell you about the hidden characteristics or hidden aspects in the price. You see, it can be compared to a ball that has been thrown upwards, and it's the speed of the ball is maximum when it leaves your hand. When you throw it towards the sky, it's going to have its maximum speed at that point. And this is similar to the financial markets as they reach their maximum level of momentum ahead of their final peak. It is very nice piece of evidence which can be added to the evidence suggested by the price, and both of them can be used in conjunction to complement each other and to uh, allot more weight towards your direction. A new high in the price, which is confirmed by the momentum index, has no technical importance to us. It doesn't say anything. It's just that both of the things are in gear and they're working perfectly as they should. So the only time we are interested in the divergences is the time when there is an offset between the price and the direction of the momentum oscillator. And bear in mind that divergences only warn of weakening or strengthening market conditions and do not represent actual buy and sell signals. So there are two types of divergences. There is a positive divergence, there is a negative divergence, and we will discuss them both. We will start off with the negative divergence. A negative divergence is a situation where a new high in the price is not confirmed by a new high in the oscillator. So the price makes a new high, but the oscillator, it doesn't make a new high, and automatically a negative divergence has been set up. This is a warning of a weakening technical structure. It indicates that the price will undergo a corrective process. It might be in the form of um, a trading range or a retracement or a downwards pattern. It only time will tell. This can be confirmed only by the price, but what the divergence is going to enlighten us with is the knowledge of the fact that the new high in the price is not being supported by the oscillator or the momentum index, and you should keep a wary eye for for its reversal. But because this is the real world and nothing works perfectly, so you have to make do with whatever comes up. Sometimes the price will continue to move up, uh, making another high, and the oscillator will not, it will make a lower high, and it might happen a third time. And so the price is making a third high, and the momentum is making a lower high for the third time consecutively. Sometimes, occasionally, the third peak of in the momentum index may be higher than the second, but lower than the first. Any of the above characteristics of a are characteristics of a sharp reversal in the price or a long corrective period. Positive divergences are the opposite of negative divergences, and the price makes lower lows, but the oscillator makes higher and higher lows. So the low of the oscillator preceded the current low made by the price. I mean, the price is making a low, but the oscillator has already reversed on the upside from the low. So it it's telling us about latent weak strengths in the price. It is always a good idea to wait for confirmation in the price action itself, because any divergence that is confirmed by a violation of a trend line in price, a crossover of the moving average, the completion of a price pattern is a really good technical phenomena. This insurance is well worth taking because sometimes indexes lose and regain momentum without suffering a break in the trend during long cyclical advance. So during linear trends, it is going to be a difficult task. But if you always wait for confirmation from the price, you are never going to be wrong. And the greater the number of divergences, the weaker the underlying technical picture. Sometimes divergences develop close to the equilibrium, and we're going to know what happens when a divergence occurs near the equilibrium point. So, if there is a divergence that is occurring close to the equilibrium line, as seen in the figure above, you see the fourth divergence. The ROC was almost sitting at the equilibrium line, and it was just waiting to fall. We had three earlier negative divergences. The price was just shooting up, but it was not getting confirmations from the momentum index, the 13-week ROC. So we shouldn't have short it at the first or the second or the third, not even till the fourth, until we got the break of the 65 exponential moving average and the uptrend line simultaneously, confirmed by the divergence in the oscillator, and the breakout towards the downside was explosive, as you can see. So when many confluence factors add up, the results are most likely to be profound. So a situation where the price moves to a significant new high, but the momentum indicator is barely able to remain above the equilibrium line, is a sign of extreme technical weakness and usually followed by a sharp decline. So it's self-evident that the price is making a new high, an all-time new high, or a new high as far as the current trading range is concerned, and the momentum index, it's barely able to keep up. It should be flying all over, away past from the overbought line, if it is a really bullish trend, but it is barely able to move up from the equilibrium line. So it is a sign of extreme technical weakness, and it's just It's just a game of wait and watch before the price gives up and the sellers take over. The opposite type of a situation in a bear market should be viewed as a positive characteristic, especially if the upward trend break in the price is accompanied by a high volume. So, whenever you're talking about going from low to high, you're talking about bullish market behavior, volume is a must. You can't be sure, or technically, it is impossible for a market to be bullish without explosive volume characteristics. So, in the other case, that the prices are dropping like a rock and they are making newer and newer lows, but the oscillator is not making lower and lower lows. It's sitting right next to the equilibrium and it's been sitting over there for quite some time. So again, it's just a game of waiting and watching, and a break towards the upside, which is confirmed by the price, either by some completion of a price pattern, violation of a downtrend line, or some moving average. The result is going to be quite profound. So it's really important to think of divergences in the context of real life. So the momentum divergences and price trend breaks can be compared to clouds and rain. If the sky is covered with dark clouds, it will probably rain, but you cannot be sure until it really does rain. So the clouds are like divergences, warning of deteriorating weather. That is the technical condition. But the change is signaled only when the first raindrop, that is, a raindrop touches your skin or the ground, and you consciously feel it. So that is the actual reversal in the actual price itself. So the example can be extended to the darker the clouds, the more probable it is that it's going to rain. So the more the divergence is, the heavier the impending price movement.